Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's take a look at what happened overnight. Global stocks weaker. Rising tensions in the Middle East saw oil rise along with gold. The US dollar fell, as did Treasury yields, while stocks on Wall Street slipped as investors reacted to softer US inflation data and a lack of detail in US-China trade talks. Selling accelerated late in the session on reports the United States is preparing a partial evacuation of its Iraqi embassy due to heightened security risks in the region emanating from Iran. Now, among the Mag 7 stocks, Amazon and Nvidia both weighed on the S&P 500. Tesla edged higher after Chief Executive Elon Musk said he regretted some of the negative social media posts he made last week about Donald Trump, saying they'd gone too far. The software development platform provider GitLab fell heavily after its quarterly results disappointed investors, and shares of video game retailer GameStop dropped after it reported a decline in first quarter revenue. Shares of Lockheed Martin fell on reports the Pentagon is scaling back by half its request to Congress for the US Air Force's Lockheed F-35 jets. And Starbucks rose on speculation it may sell its China business as it grapples with stiff competition from cheaper coffee offered by local rivals, having lowered its prices in its second largest market. Well, US consumer prices increased a less than expected 0.1% in May as cheaper fuel partially offset higher rents, with the annual consumer price index advancing 2.4%. However, inflation is expected to accelerate in the coming months because of the Trump administration's import tariffs. On the tariff front, President Trump says a trade framework with China has been completed, which includes an agreement for China to supply rare earths, as well as allowing Chinese students access to American universities. But a White House official has said the agreement allows the US to charge a 55% tariff on Chinese exports, which includes a 10% baseline reciprocal tariff, a 20% tariff for fentanyl trafficking, and a 25% tariff reflecting pre-existing tariffs. Well, yields on US Treasuries declined for a third straight day on softer inflation, with the 2-year falling to 3.94% while the 10-year fell to 4.41%. And an auction of 10-year Treasuries showed healthy demand for longer-dated securities. The US dollar index fell 0.5% following that inflation data. And the Aussie dollar initially jumped to close to 65.5 US cents, but then retraced those gains on news of US-Iran tensions. It's currently at 65.1 US cents, and Bitcoin is trading at around 108,500 US dollars. Well, oil prices have surged to their highest in more than 2 months on reports that the US is preparing to evacuate its embassy in Iraq due to heightened security concerns in the Middle East. Non-essential embassy personnel in Bahrain and Kuwait have also reportedly been told to leave. And the UK has issued a warning to vessels transiting the Arabian Gulf, Gulf of Oman and Straits of Hormuz. Brent crude futures close to 4.5% higher at around $70 a barrel. Gold has risen on safe haven demand in response to those heightened geopolitical risks. Spot gold up 1% to $3,353 an ounce. Well, for a closer look now at the macro picture with a focus on currencies and particularly where the US dollar is tracking, I caught up earlier with Ntonifor from BCA Research.
What I would say is that the market pays a lot of attention to the day-to-day numbers that come out. But I think there's a much bigger picture that the market needs to be paying attention to. The first is the fact that we have like on the US dollar specifically, and does not necessarily have to deal with inflation, but has to deal with the fact that you're getting outflows that are coming out of the US. That is driving the dollar lower. So the most important driver recently has just been the capital flows that are shifting from the US to other markets. Obviously, a soft CPI, tells you that the Fed could easily, lower interest rates. But I don't think that that's necessarily the bigger driver. The bigger driver is these capital flows. These capital flows have been driven by a couple of things. The first is that there's geopolitics that's involved, and so investors want to diversify their assets away from the US towards other markets. That is a structural trend. You've seen gold appreciate, you've seen precious metals appreciate, and all of that. And that is going to continue. The second factor is that investors are now asking the US that we need to pay a higher term premium on investing in your capital markets. And so, given that the US runs a huge current account deficit, and that deficit is expected to at least expand over the next few years, we have this situation whereby investors are disciplining both the FX market and the bond market. The discipline on the bond market is happening via the fact that the term premium in the US is rising. And the discipline in the FX market is going to come from the fact that, well, the dollar is simply uncompetitive. Like if you look at our valuation models, we have an overvaluation of like 24-25% on the US dollar. So that needs to come down to be able to allow the US current account to balance. So I don't necessarily think it's a story about CPI. I think we are playing a longer term game here, whereby when you're looking at current account balances, the currency and all that, you sort of need to calibrate how the equilibrium mechanism works out, and the equilibrium mechanism is a lower US dollar over the long term.
So, Chester, where do you see it tracking, particularly over the next 6 months towards the end of the year, given those capital outflows you talk about from the US and also that debt position?
Towards the end of the year, so I mean, to be honest, I cannot time what's going to happen. I don't know, like I'm not a political insider, so I don't know what's going to happen over the next 3 months, 6 months. When I'm looking at the dollar, I am looking at two factors. I'm looking at the structural factor, which I've just talked about, and I'm looking at the tactical, the tactical indicators that I tend to track. Tactically, this story that I'm telling you is well telegraphed in markets. Most people are bearish. The dollar is down. You've seen currencies like the British pound, the Australian dollar appreciate quite, quite aggressively. So I think in the very near term, you could see the dollar appreciate in order of magnitude of, call it 3-4%. If you're a strategic investor, you want to be selling on strength. If you're a tactical investor, maybe you want to be playing that. So towards the end of the year, I think it's going to be based on the vagaries of what comes out of politics. Now, what I'm tracking are my tactical models. We have a couple of tactical models that we look at, and those are clearly telling us that over the very short term, the dollar is oversold. But when we look at the structural factors that are driving the dollar, it's telling us that the dollar is going to head lower over, call it, an 18-month, 24-month horizon. So 6 to 12 months. Yeah, you might want to play tactical bounce. I think that can happen over the next 1 to 2 months, but over the longer term, you want to be using that bounce to sell into the dollar if you're a strategic investor.
All right, so Chester, you mentioned the Aussie dollar there. Let's take a look at it. It has more recently struggled to maintain strength above 65 US cents. It seems to be gaining some strength there. How do you see it tracking? Is it more a function of what we're seeing with the US dollar, or is there also an issue just as far as, I guess, that interest rate differential we're seeing between Australia and the US at the moment?
Yeah, the Aussie dollar is one of the currencies in which I have one of the strongest longer term conviction view on. And it's based on a couple of factors. Number one, the Australia sits at the nexus of the green energy revolution. So exporting a lot of critical minerals that China needs, that the US needs, that a lot of other economy needs. And it's gonna sit there for quite a bit of time. Number two, in this energy transition that we were talking about, Australia is one of the biggest producers of liquefied natural gas, whereby we need this energy source to be able to transition us from coal towards a green energy revolution. So Australian liquefied natural gas companies, like we're talking about the Santos of the world and all of that, for me, like a very, 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 very big bet. And then the final point is symmetrically to what you mentioned, the Australian dollar is undervalued relative to terms of trade. So when you're looking at the US dollar is very overvalued, has to depreciate to be able to gain competitiveness. When I look at my models, it's telling me that the Australian dollar is undervalued. So I see in the short term, a bounce in the US dollar would cause the Australian dollar to depreciate, maybe in order of magnitude of maybe call it 2 to 3%, but that's a tremendous buying opportunity over the long term.
Chester Ntonifor from BCA Research. Let's now take a look at where we're likely to get going when we open in a minute or so. SPI futures indicating a positive start. We're looking to build on those gains and perhaps reset another record high. So SPI futures up around 0.25%. Stay with us. We'll get right across that in just a minute or two.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.